Welcome to the deep dive. We're your shortcut to, well, figuring out what's really going on behind the headlines.
Yeah, we dig through the reports, the calls, the notes, all that stuff.
Exactly. We pull out the important bits, maybe a surprising fact or two, and hopefully keep it interesting along the way.
Try to. Anyway,
So today we're doing a deep dive into Apollo Global Management. They just had their second quarter 2025 results come out.
and they were pretty impressive, yeah.
That's the mission for today, then. Let's unpack what these big numbers mean for Apollo's strategy, maybe the wider financial world, and what it could mean for you listening.
Right. We've got the earnings call transcript, the press release they put out, plenty to chew on.
Okay, let's jump straight in then. The core of the quarter. It's just outstanding performance, really. They hit record fee-related earnings, FRE, they call it, $627 million.
Which is huge. That's what, 22% up year over year?
Yeah, 22% jump. And it wasn't just FRE. Capital Solutions ACS fees, also a record, $216 million.
Right. So broad-based strength on the fee side.
Totally. And the bigger picture looks just as good. Management fee growth, 21% year over year.
Okay.
And their assets under management, AUM, that hit a new record too, $840 billion as of June 30th.
So huge numbers. But what's really fascinating, I think, is what's driving those numbers. It really comes down to origination.
Okay. Explain that.
Well, they originated $81 billion just from their own platforms and business this quarter. That doesn't even count inorganic stuff.
81 billion. Wow.
Yeah. And if you do count the inorganic, it's over $90 billion. But the key thing, the phrase they keep using, is originating assets with excess return per unit of risk.
Okay, sounds good. But what does that mean in practice?
It means they're not just buying stuff off the shelf, they're using their networks, their data, to find or structure deals that give a better return for the risk involved. Something you probably couldn't just get in the public markets.
Gotcha. Like specific examples.
Yeah, they gave some good ones, like $60 billion of investment-grade credit, average rating A-.
Pretty safe stuff.
Right. But it yielded an excess spread of around 290 basis points over treasuries. Or, maybe easier to compare, about 190 basis points over similar corporate bonds.
So a significant extra yield for high quality.
Exactly. And then on the riskier side, sub-investment grade, they did $15 billion, average rating single B.
Okay.
And that generated an excess spread over 470 basis points over treasuries, or 200 basis points over similar high-yield bonds. So even when parts of the market tighten, they're still finding that extra spread.
That really shows the power of that origination engine. And I guess that explains the inflows.
It absolutely does. They pulled in $61 billion across the whole firm in the quarter.
61. Okay.
And get this, $49 billion of that was organic inflows. A record for them.
49 organic. That's investors really buying into their story, isn't it?
It's a huge vote of confidence, definitely.
So with that baseline of strong origination and inflows, let's peel it back a bit. How did things look within their different asset management arms, like Credit First? That's their biggest, right?
Yeah, credit's the giant. And it performed really well pretty much across the board. Their core opportunistic credit funds, they saw returns like 9 to 12% over the last 12 months.
Solid.
And 23% just quarter over quarter in some cases. They also talked up their Apollo Debt Solutions Fund, ADS.
Right, ADS. Heard of that one.
It's hit over 9% annual return since it started, and it's now bigger than $20 billion.
20 billion. Wow.
And what's key there is they've grown it without changing their core principles. They're still focused on being at the top of the capital structure, getting paid back first, and using lower leverage.
So scaling without adding a ton of risk.
That's the idea, responsible scaling.
Okay. Credit looks strong, but private equity always gets a lot of attention. How did their PE funds do? This is where it gets interesting, I think.
Yeah, PE is definitely a focus, and the numbers were good. Fund 10, their latest big one, is showing a net IRR internal rate of return of 23%.
23% net.
Nice. And Fund 9, the previous one, is at 16.6% net IRR. But maybe more importantly, look at the DPI that's distributed to paid-in capital.
The cash back to investors.
Exactly. Fund 10 is only at 0.2% DPI. It's still very young, but Fund 9 is at 0.7%. And that 0.7 is way ahead of the industry average for funds of that age. They're getting cash back faster.
Why is that? What's their approach?
They talk about their philosophy, alpha on the buy, alpha on the build, and alpha on the exit. Been doing it for 3 decades.
Right, so finding a good deal, actually improving the company, and then selling it smartly.
Precisely.
Yeah.
Not just financial engineering. It's led to, historically, 39% gross and 24% net returns over that long period. Disciplined execution.
Okay. And what about the hybrid segment? They seem quite bullish on that.
Yeah, they expect it to be their fastest growing business, actually. It did 17% over the last 12 months, LTM return, and it's managing $75 billion now.
$75 billion in hybrid.
And the flagship product there is Apollo-aligned alternatives, or AAA. That returned 11.1% LTM. The key there is it did it with much, much lower volatility than public stocks.
That's bumpy ride.
Exactly. And that vehicle, AAA, they expected to cross $25 billion by the end of this year.
So strong growth. Any surprises there?
Yeah, actually. A big one with AAA. The fundraising mix has shifted. Institutional money coming into AAA is now bigger than the retail money coming in.
Really? Institutions are moving in more than retail now?
Yep. And apparently much earlier than Apollo themselves expected. Institutions are looking at it for equity replacement.
Equity replacement. That's a really interesting framing. Not just alternatives, but actually replacing core equity holdings.
Seems like it. I think it's that combo of decent returns, income, but critically lower volatility than just holding the S&P 500.
Yeah. Yeah, that makes sense in this environment. So institutions are looking for smoother returns, maybe?
Could be. Or just better diversification. It suggests they're rethinking that traditional 60-40 portfolio construction. AAA offers something different, a private market solution with potentially equity-like returns, but maybe less drama.
Okay. And amidst all this deployment and growth, they're still sitting on a pile of cash, right? Dry powder.
Oh, yeah. $72 billion of dry powder.
Yeah.
Ready to go when they see opportunities.
$72 billion. Okay, definitely poised for more action. Let's switch over to the other side of the house, retirement services, Athene.
Right, the insurance arm.
Demand for annuities seems sky high right now. You've got high rates making them attractive, plus, demographics, baby boomers retiring.
Absolutely. The demand is huge, and Athene is capitalizing. They had $21 billion in inflows in Q2.
$21 billion. Wow.
Yeah, their second best organic quarter ever. And they're flexible. They can originate in different areas depending on the market. This quarter, fixed annuities and funding agreements were really strong.
What's their edge there? How do they compete?
A huge part of it is their cost structure. They mentioned their cost of doing business is some 16 points.
16 points. What does that mean?
It's basically a measure of their operating expenses relative to their assets. And that's 16 points. It's roughly half the cost of their bigger public competitors and maybe a third of some newer entrants. Super efficient.
Okay, so that low cost base must really help profitability long term.
Massively. It lets them keep more capital, reinvest it, and still offer competitive rates. It's a big structural advantage.
Now, they did talk about net spreads potentially declining a bit, something about business written post-COVID burning off.
Yeah, they addressed that. So their current reported net spread is 122 basis points.
Mm-hmm.
Pretty healthy.
Mm-hmm.
They expect that might dip slightly through 2026. Why? Because some really profitable annuities they wrote right after COVID, when spreads were unusually wide, are naturally running off the books.
Ah, so the super profitable stuff is maturing.
Exactly. And this is the crucial part. The new business they're writing today has strong spreads, around 130 basis points.
Mm-hmm. Oh, okay. So new business is actually more profitable on a spread basis than the current average.
Looks like it. It shows the underlying business is still very healthy and focused on long-term profitable growth, even as that older block amortizes. It's not a sign of weakness in the current operation.
That makes sense. Healthy new business replacing the old. And they've been making some acquisitions too, haven't they?
They have. The Bridge Investment Group deal is strategic. They expect that to add about $100 million to fee-related earnings starting in 2026.
Okay, so a direct boost to the bottom line coming.
Yep. They also mentioned Lending Ridge acquired Radian's mortgage insurance capabilities. That seems more about building out expertise, though. Didn't really move the needle much on fee-paying AUM this quarter. More of a capability build.
Right. So putting all this together, strong performance, smart acquisitions, the Athene engine. What does this signal for the bigger picture? How is Apollo looking beyond its traditional base?
Well, this is where it gets really expansive. They're not just relying on the traditional institutional clients anymore. They explicitly laid out 5 additional sources of demand they're tapping into.
5 more. Okay, let's hear them.
Right. First, individuals, the global wealth market. They pulled in over $4 billion just in Q2 from this channel.
$4 billion from individual investors in one quarter.
Yeah, their second best quarter ever for that. It's coming through 18 different strategies, reaching like 5,000 advisors at almost 700 firms. Products like ADS, that debt fund we mentioned, and their asset-backed credit fund, ABC, are big drivers. They think ABC could be as big as ADS eventually.
Okay, so wealth is number one. What's two?
Second, insurance companies. Other insurance companies, not just Athene. They're increasingly seeing Apollo's origination skill. That led to $7 billion in third-party insurance inflows this quarter.
$7 billion from other insurers. Okay, why are they coming to Apollo?
Because they see the Athene model works, basically, using those long-term insurance liabilities to back-originate high-quality private assets. Apollo can provide that origination.
Makes sense.
And
Third,
institutions. But in a new way. Not just for the alternatives bucket, but also for fixed income replacement and, like we talked about with AAA, equity replacement.
Right, the portfolio construction shift.
Exactly. Fourth, traditional asset managers. Think the big mutual fund companies. They're starting to blend private assets into what used to be public-only funds. Active management is evolving.
That sounds like a huge potential market.
Oh, they said very, very large market.
Opens up totally new client bases for Apollo strategies.
Okay, that's four. What's the fifth? This must be the big one.
It might be the biggest long-term. Number 5, the 401k and defined contribution marketplace.
The retirement savings pool. Massive.
$12 to $13 trillion in the U.S. alone. They're anticipating and, frankly, pushing for regulatory changes to make it easier to put private assets into these plans.
Why? What's the goal there?
Better outcomes for retirees. They estimate that over long periods, adding private assets could improve retirement outcomes by 50 to 100%. 50 to 100% better. That's transformative if it works.
Huge potential. It's still early days, lots of regulatory hurdles, but they're already experimenting. Getting billions in through managed platforms, target date funds, sort of indirect access for now.
So across all these new areas, it sounds like innovation is absolutely critical for them.
It really is. They gave concrete examples, partnerships like with State Street, Lord Abbett, Empower, to get their products into new channels.
Okay.
They're looking at things like stablecoins, maybe tokenizing assets down the line. But the one they seem most excited about, the potential game changer, trading of private assets.
Trading private assets, like making illiquid stuff liquid.
Kind of. They argued that in basically every other asset class where transparency and daily pricing became available, the market exploded in size. Think about mortgages or corporate bonds decades ago.
Right, transparency brings in more participants.
Exactly. They think if they can crack that for private assets, make it easier to value and trade it, could turn our industry on its head. And obviously, they think the winners in that world would be the ones like them with the best origination capabilities.
Interesting. So creating a more liquid market for the very assets they originate.
That seems to be the long-term vision. And they're not just focused on the U.S. Europe is a big push, too.
Oh, yeah. What are they doing there?
Well, they have their strategic investment in Athora, which is kind of their European insurance platform. And they just agreed to buy PIK, a pensions insurer in the UK.
Okay, building a UK base?
Yeah, they see the UK pensions market as a sizable capital funding source. The idea is to build a big pound-based origination ecosystem there, kind of like Athene does with dollars in the U.S.
And a theme for the UK, essentially.
Kind of, yeah. Plus, they mentioned a $100+ billion commitment to Germany for various growth projects. And they see a huge opportunity in European asset-based finance if securitization rules get reformed over there.
So lots of international expansion. What about specific themes? Anything jump out?
Definitely. Energy transition and decarbonization. They've put nearly $60 billion to work there since 2022.
$60 billion already?
Yeah, they actually beat their 5-year goal almost 2 years early. Shows the scale of capital flowing into that space.
Wow.
And another big one, AI infrastructure. They estimate it needs $1.5 trillion in external funding globally. Within that, they see an $800 billion opportunity just for private credit.
$800 billion just for private credit for AI build-out. The scale is just mind-boggling.
It really is. It raises questions about where all that capital comes from, but they clearly see a massive role for private lenders like themselves.
And again, it comes back to that origination point, doesn't it? Being able to source those deals directly.
100%. They stress the value of direct origination versus just buying assets someone else created.
Yeah.
And their network of bank partnerships, they have 12 now. Plan to add more is key to that differentiated sourcing, finding deals others don't see.
Okay, so wrapping this up. What's the main takeaway for someone listening? This deep dive really shows a company that's firing on all cylinders, wouldn't you say?
Yeah, absolutely. The momentum seems to be building, not slowing down, across asset management, across Athene, across these new growth areas.
And if you're an investor, maybe not directly in Apollo, but just watching the markets, it shows this huge shift towards private assets isn't stopping. If anything, it's accelerating and broadening out.
That's right. And from Apollo's perspective, the bottleneck isn't really demand. People want these high-quality private assets, especially in this environment. The real challenge, the limiting factor, is just their own capacity to keep originating enough good deals.
Fascinating.
Yeah.
So maybe the final thought to leave everyone with, something to chew on. We see this massive need for guaranteed income in retirement, right? And these enormous pools of money sitting in 401ks and similar plans.
Trillions.
So how does the financial world actually bridge that gap? How do they deliver private asset solutions with potentially better returns and smoother rides to the average retiree in a way that's simple, understandable, maybe even easily tradable like they envision?
That's the multi-trillion-dollar question, isn't it? If they can make private assets accessible and maybe even liquid for regular retirement savers, that changes everything.
Definitely something to think about. We'll have to see how that plays out. Thanks for joining us on the deep dive.